Good evening, everyone. Welcome back to the second session on the working capital management. I'm hoping that each and everyone is keeping in good health, and also assuming that from the last session you guys got some time to go back and study about the operating cycle and the calculation of working capital, and especially the last illustration we were working on for submarine enterprises. I hope you guys got a chance to went back and actually have a look from a recomputation perspective. So great. Again, I can see a lot of excitement already onto the session, and welcome you all. And today we will be proceeding towards the individual components for the working capital management. Just to do a quick recap of what we did in the last class. We started with importance of the working capital. We talked about the significance of the working capital policies, moderate, aggressive, or in the balance. Then we also talked about the scenario of profitability and the liquidity, both sides plus and minus. We moved on to the calculation of operating cycle. That is what all the components of operating cycle are. And the more, or rather the shorter the operating cycle, that is more the number of operating cycles in a year, better for the company's operational efficiency. Then we moved on to the calculation of the working capital. Focus on was the various components of the inventory, especially the raw material, WIP, finished goods. I'm sure the WIP was something you needed to be careful about as far as inventory is concerned, especially the illustration we did for the X something accruing evenly throughout the year. And in the receivables, you had to be very careful on the cash cost, right? And then we moved on to the current liabilities, the margin, and so on. So I'm pretty sure that a good recap for whatever we discussed in the last class, and I'm sure you guys went back and actually practiced a few questions. So today we resume our discussion from that point to treasury management, and I'm sure that I think some of you were a little worried about how we guys will be covering in today's session. I'm not sure if you have already looked onto the revised schedule. So we will be ending the working capital instead of today on. We will be having a last session on Saturday as well. So we'll be kind of moving ahead to whatever left and some bit of practice on the last day, that is on Saturday, guys. So I'm sure that gives a little bit of a relief to some of you who were worried on that day. So let's start today's session, guys, from treasury management. Now, when it comes to the treasury management, this is again a very important aspect of the working capital aspect. Of course, we understand it's the current assets part of the current assets, which is like cash in bank. So any finance manager, especially in the treasury, and they used to negotiate with the banks, guys. And the negotiation used to be with respect to the fixed deposit rates for 5 days, 7 days, 10 days. And I was like, really? Can anyone tell me here what could be the significance of the negotiation of fixed deposit rates by corporates with banks for, let's say, 5 days, 7 days? Can anyone tell me what could be the significance of that kind of a negotiation? Can anyone tell me? Okay, in the meantime, I'm just quickly looking at a point which is asked by Charu. But in the meantime, I'm expecting you guys to respond to my question that why would the corporates negotiate for fixed deposit rates for 5 days, 7 days? Can anyone tell me? Okay, Charu, the answer to your question is, when we talked about the labor and overhead for that WIP for the half month, that was for the month of WIP because that was accrued evenly. But when we are calculating that as a component of current liabilities, that's a good question actually. But in the current liabilities as accounts payable or outstanding expenses, I think there was a separate information given that they were paid in 1 month in lag, right? So there are two things: how the elements went into the production element that was flowing evenly throughout the year in the WIP, and how the actual payment was to be made, that was a second element. So Don't mix them up. I think the treatment was separate, one with respect to WIP and one with respect to the creditors. I hope that is clear now to you guys. Okay, so great guys. I can see that there is a response coming in from Apuja, Vrinda, Vasu, and Saurabh to earn interest. They have large funds to invest. Short-term money need. Amazing answer, Pooja. Short-term money need. I really like that short-term word over there. And even Saurabh said to get some return on idle funds. Guys, think from a Treasury Department perspective. They might need to manage the flow of the funds in such a way that they need to ensure three things. They need to ensure three things, guys. One is they need to ensure that no payments are delayed. Every payment that is scheduled to be on the particular date, that has to be done by that date or before that date. Second, they need to accelerate the collections. And third, which is a byproduct of the first two activities in terms of a timing. Let's say if there is a timing between a collection and a next payment, and you have some time lag, during that time when the funds are idle, can we invest them somewhere in a short-term deposit or a fixed deposit or a risk-free marketable security, so that we can liquidate them in 1 week and we get some return and we kind of get the maximum out of the idle funds. Those are the three basic objectives, isn't it? Yes. So I think Saurabh, Vasu, that's absolutely. So Vasu has made an interesting point. So what happens is that when we talk about the collections and payments in terms of corporates, that's into crores. Vasu, again, a very, very good perspective on that. That you're talking about crores or multi crores over there. So even a 5-day interest can run into lakhs, right? So that's amazing. So and even Madhushri replied the same. So good guys, you're absolutely on the right note. So let's talk about the goals here. Whatever I have kind of minimized or rather summarized here in terms of maximizing the return. So that's of course the one aspect. Minimizing the interest cost on borrowing. So that's the second part, guys. So let's say you're talking about borrowing from the bank. So that also acts as a part of the treasury management when you are acting, as a liaising between the bank officials and on behalf of corporate. You would like to minimize the interest cost, and not only that, you're talking about mobilization of cash. When I say mobilization of cash, it's about timing, right? You're talking about forecasting and actually timing of the funds. Now, another important aspect of the Treasury Department is actually something with respect to risk coverage, and that is something when we're talking about these days, most of the corporates are dealing into country or global operations, and when that happens, you may end up incurring any kind of a loss due to foreign currency fluctuations. So the best way to cover that, to hedge that kind of a risk exposure is probably to enter into some hedging contracts available in the market. Let's say we're talking about a future contract or something like that. So hedging would be another objective, a very important one. And a lot of insight goes into that with respect to the movements expected in the Forex domain. So in a nutshell, if you're talking about keeping these goals in mind, so the responsibilities here is probably bucketized under 5 heads. One is the cash management. We're talking about responsibilities or functions. Cash management, which I said, okay, you need to manage the timetable in terms of the exact dates when the cash collections are done, when the payments have to be made, and the most importantly, the investment of surplus funds. Second bucket, you are the face of the corporate, guys. You are liaising with the banking teams, with the various banks. So that means for you, it's important to maintain good relations, because then only you are able to in a position of negotiation over here. Fund management, I think who knows better than you guys. So you have all studied about the, with respect to the sourcing, with respect to the investing, with respect to the time duration. So that comes under fund management, right? Then currency management, just I explained when we're talking about with respect to any kind of a Forex exposure. whether we can, time our forex payments and receipts in such a way that we minimize the exposure of any kind of a forex fluctuations. And one important function which has gained significance over the number of years is the corporate finance responsibilities, guys. Now that happens where you're talking about acquiring other corporates, doing that due diligence, valuing the businesses, and enter into acquisition, or even splitting up if you want to specialize into certain activities, and if you want to split up into different companies, and of course maintaining the investor relations as well. So these are various important aspects with respect to the treasury management, but specifically we are focusing right now with respect to the cash management here. I think we all agree to that fact that right from your first lecture we understood that, okay, what blood is to a human body is the finance to any business here, right? So in terms of cash management, we need to understand what are the various reasons for the company to hold cash. And when I'm saying cash, guys, am I talking about actual hard cash? Of course, it could be electronic money or a hard cash, both, right? So we're talking about cash in bank here. So what is the reason why the companies need the cash in bank basically? One is, of course, to meet the day-to-day expenses. That's a transaction need. So we're talking about the transaction need here. I think another important aspect that you may end up into having any kind of an unplanned event, sudden requirement which was not foreseen. That's called as a precautionary need, guys. And as I said, if you have surplus funds, you definitely want to take an advantage of any temporary arbitrage in terms of any kind of a movement in the stock market or profitable opportunities, any kind of a short-term investment. That's called a speculative need here. Now, whatever the needs, whatever the functions, what's important is, guys, we need to understand that accurate planning in terms of the cash forecast, both in terms of receipt and in terms of payments, is very important. In a nutshell, what we are looking at is a coordination, a proper coordination. That is very important here, because we need to understand that, hey, we should not be ending up in a situation that there has to be a bulk payment has to go to the vendors and you don't have liquidity. You don't want to end up, into that kind of a situation. So that means the forecasting of the cash inflows and outflows become very important, because you want to avoid unnecessary holding up of the idle funds. And not only that, you probably want to avoid any kind of a shortage as well. Now, having said that, it becomes very important that, you're looking from a perspective of how do we ensure that we are looking at a cash inflow and an outflow? How do we coordinate that? Any thought process? Anyone? Any thought process, guys? How do we forecast the cash receipts and payments? How do we forecast? Let me see your responses. Okay. How do we forecast the inflows and outflows? Okay. So I'm getting some response. Jamil says, looking at the debtors and creditors. Okay. Vasu says, on the basis of payment cycles or timelines. Good. Pooja says about preparing cash flow statement. I think that's the response from one more student. And I think pretty much, kind of agreeing with what Vasu is saying, that, maybe we can do or time our receipts and payments. But what are we looking at, guys? Can we say that probably we can prepare some kind of a cash forecast or a cash budget, guys? So we can prepare some kind of a cash forecast or a cash budget, guys, where we know that, okay, generally this is the credit period we are allowing to our customers. They will be paying, their payments on certain dates. This is the credit period allowed by the vendors, and we can accordingly. So we need to know certain things. When we're looking at cash budgeting, probably we need to know we need to forecast the sales. We need to forecast the cash sales, credit sales. Similarly, we need to forecast based on that what will be the payments to the vendors, and accordingly we need to understand, okay, hey, whether I'm basically ending up by any chance to have any unnecessary excess or any problematic shortage over there. So we're looking at a cash budget over there majorly. Okay, so more responses which came from Madhushree and Mancha. Mancha says scientific and estimation including risk factor. Yeah, so that's exactly budget, as you said, Mancha, at the end. And similarly, Madhushree also talked about the budget. But anyways, we're talking about different methods of cash budgeting here. One is a very basic one, that is a receipts and payments method, where you need a periodic flow, or we need an understanding of, okay, how many, like, can we have information for the next 3 months or 6 months and prepare a cash budget? And we will be spending some time on that as well. And there is one method which is based on the financial statements, rather two methods. One is based on the adjusted income statement, and one is based on the adjusted balance sheet. Now, these two methods, since we know that the financial statements are more or less prepared on the accrual basis, needs to be adjusted, right? So in income statement adjusted method, of course, whatever the changes in the balances with respect to the credit period, or we can say any kind of a delays in the payments and the collection, that has to be adjusted, because the entire income statement is based on the accrual, guys, right? So that is something adjusted income statement. Similarly, for the balance sheet piece, again, the aspect here is that what we do is, all the assets and even the short-term liability, we express them, we generally convert them as a percentage of their revenue. And again, the idea is that how much funds are coming in and how much funds do you need with respect to the liabilities. Our focus would be more on the cash budget on the basis of the receipts and payments method, though, and we'll be talking about a little bit of with respect on terms of the practical exercise. So of course, the significance of cash budget is again a very, very important aspect, because that is where, or that acts as a single device to plan and control our cash receipts and payments here. Now, as I said, if you have a surplus, you can end up investing in marketable securities or even the short-term deposits, as in even for less number of days. And if there is a shortage position, you could have license with the bank for any kind of an overdraft facility, guys. Now, so that means the basic purpose for these cash budgets, what are these? So we're talking about, of course, the coordination, as I said, that's very important, the entire coordination exercise. Then we're talking about, okay, when do we have excess cash, or how we can take an advantage of any kind of a short-term speculative position, or can we take any advantage of a credit period with respect to any kind of a discounts offered on its accounts payable. We'll talk this probably a little later. What about the cash discounts on accounts payable? So what happens is generally the suppliers can give you a credit period, let's say 30 days. And they tell you that, okay, if you make the payment in 10 days, we will be giving you a 2% discount. So we generally use a credit term like, N30 2/10. So that means you're talking about, okay, 30 days is the time period. And if you pay 10 days, you get a 2% discount. Now, whether to take that 2% discount or not, we will discuss a little later though. And of course, the idea is that in case instead of excess, you end up in the shortfall of funds, you should be in a position, you should have negotiated that arrangement with the bank so that your operations doesn't stop, guys. You should have negotiated in advance with any kind of overdraft facility, any kind of CC facility that may be made on a favorable terms to the organization. And that how that would have happened, that would be the result of negotiations. Okay. So let's talk about this. When we're talking about what are the steps involved in terms of the cash budget. Of course, first of all, we need to know that for what period are we talking about? For a quarter, for a 6 months, for an entire year? So and also we need to understand, okay, what are the factors affecting these periods, guys? Because one is day-to-day operations. Then there could be some ad hoc timing requirements, like there could be a replacement of a machinery coming up, right? So there could be a significant financing coming up. So we need to categorically understand the requirements with respect to, hey, what are the operational cash flows, what are the investing cash flows, and what are the financing cash flows. So the idea is that, okay, on an average, what amount of funds you would always like to keep in hand for any kind of an unforeseen situation, right? So anything over and above is called a cash surplus, and anything less than that, that's a kind of a deficit, guys. And that deficit is something would be a little worrisome unless and until you have in time arrangement of a overdraft facility over there. So we understand, okay, when we're talking about a cash budget, we will be analyzing this in terms of two aspects, for a short period and for long period. Now, generally, for our examination purposes also, we will be focusing more on the long, on the short period cash budget, where we'll be doing let's say a 3-month or a 6-month budgeting. And just for our understanding, we will spend some time on the long-term cash budget as well. Okay, so when we are preparing the cash budget for a shorter period, you need to understand, okay, that you need to account for my receipts, account for my payments, and very logically, the ending balance of 1 month becomes the opening balance for the next period. And we need to identify which months we have excess or which months we have any kind of a shortfall, guys. Now, I think in the questions related to the cash budget, specifically with respect to the receipts, sometimes students do a mistake that, okay, they are talking about, okay, how does the customers make the payment next month or the second month? But they somehow do a mistake which could relate to just missing out even the cash sales. Don't forget that any sales, you might have a cash sales, of course. Every month you would have a cash sales and credit sales. So cash sales will be accounted for in the same period, but of course the receipt of the credit sales would be in the subsequent months. So every month you would have these two components with respect to the receipts, guys, right? And not only that, from the sales, you may be having any other receipts of cash coming up. Now, with respect to payments though, of course, you need to have a payment for the purchases. Again, I would say cash or a credit. And then any kind of an expenses. Now, as I said, when we are looking for a short period, guys, what happens? Can anyone give me an example? Any payments that might be done periodically, not every month? You might have certain cash payments that might be required in some months, but not in every month. Can anyone give me an example, guys? One is day-to-day operations. But we might also have some payments which may be affecting certain months. Let's say I am preparing a budget for, let's say, April to September. Can there be an example, okay, that okay, this payment will be made in the month of June and September, but not in all the 6 months? Okay, let's see if there are responses on that. Okay, perfect. Okay, Vasu is coming up with the mobile recharge. Okay, so for corporates, I think, Vasu, we can think of a further macro examples. I think the response given by most of the students relate to, like, Vrinda or even Pooja, that which relates to income tax, guys. Income tax. Some people are giving me example of Khushi and all are giving me example on insurance as well. That could be good, but insurance expense, I think, Khushi, you're not talking about insurance claim or insurance expense, I guess, right? And then there are certain examples which relate to any kind of interest on loans. Okay, interest on loan, unless you are having a quarterly payments, that could be. But if you are having an EMI, you might have that on a monthly basis as well, right? But yes, I think one piece you are missing is when you're talking about interest on income tax, then there could be also indirect tax liability, just like a GST or a sales tax, right? That could be on a periodical basis. They could be monthly or periodically, right? But all examples are absolutely good. So what we are looking at as a third point is your periodical payments need to be taken care for in the specific months to which they relate to. Right? So you guys gave me all the good examples like income tax, interest on debentures, and all this. And of course, if there are any ad hoc ventures coming up, let's say we're talking about in the fourth point, that is any dividends and any kind of redemption or a bank, repayment, bank loan repayment coming up in a particular month, or even a acquisition of any non-current assets. So those are These are the things generally based on estimates, guys. Now, if I have to prepare a cash budget, any kind of a budget, guys, forget cash budget for a moment. Can you tell me what could be the starting point of any budgeting exercise? What do you need to know first to actually prepare other budgets? What do you need to know the first before even going for any other budget, guys? Anyone over here? What would be the starting point? Okay, let's see the response. All information about cash. Wow, opening balance. Kushi says opening balance. Vasu says. So guys, I think I should repeat my question. I am saying that forget about cash budget. Think about overall budgeting exercise by an organization. What would be the first number or first information or first budget you need to prepare? Will the cash budget be the first budget, guys? Or probably you need to have some other information before even preparing cash budget? I think the easy answer would be whatever the information you are seeing in the cash budget, those are the budgets. Like for specifically, okay, everyone is telling me opening, closing, balances, cash available. Yeah, I am liking few responses. Saurabh, Surbhi, and Pooja, you guys are spot on. So some responses coming on, guys. Sales forecast. You need to have see all the year estimates, right? So sales forecast. So only when you have sales forecast, on that basis, you are talking about production requirements. On that basis, you are talking about the purchase requirements and hence the expenses. So that's the answer I was looking for. So I hope you are pretty much clear on that logic, right? So the first information an organization would definitely need a sales forecast. Yes, absolutely perfect. Surbhi, Vasu, Narayanan. So that is absolutely correct. Okay, so let's take an example, guys. Let's do some kind of a hands-on here. So you're looking for an example here which talks about a monthly cash budget here with respect to 6 months beginning from April 2019 on the basis of below details. So we are given estimated sales, guys, and this is what I was talking about. The first number we are talking about is sales here. So they've given us sales for 10 months. That's amazing. So Jan to October. They've given the information with respect to the wages, and there are some information given to us. Of the sales, 80% is on the credit and 20% for cash. 75% of the credit sales are collected in 1 month and the balance in the second month after the sale, guys. And there are no bad debt losses. Purchases amount to 80% of the sales. Now this is important, and are made on credit and paid for in the month preceding the sales, guys. Now the firm has 10% debentures of 1,20,000. Interest on these has to be paid quarterly, January, April, and so on. Firm has to make the advance payment of income tax as well. And then they're talking about, okay, also a cash balance is given, and they're saying that, okay, 20,000 is the minimum cash balance you need to take, and any cash above this would be, probably looking at a temporary investment. And if there is a shortage, you could be having a temporary borrowings as well. Okay. Okay, Pooja is asking me why they are not differently put like payments to purchase and payment. So, Pooja, if your question was with respect to the last slide, so we will be talking about payments for the goods purchased and other expenses separately if required. So that is dependent on the information given in the question. I hope that makes sense to everyone. Okay, guys, how do we proceed in this case? We are required to prepare 6 months budget, but somehow we need to know, okay, what is the amount going on with respect to the receipts and payments. A lot of calculation might be required in this context, right? Yes, what do you think? What should be our starting point in this case? What should be our starting point? Anyone? What should be my starting point, guys, in this case? Any thoughts? So let us do one thing is follow a step-by-step exercise in this case. So we are talking about a cash budget, and let me do one thing. Let me just switch it over to the board, and I want, in case it is feasible for you guys can quickly take a snapshot of the information given here on the screen, and then you can definitely help me out in do some workings here, guys. Okay. So I got a response from Mansha. Mansha says that we need to calculate separately the collection from debtors. And I think probably you might also need to calculate the payments to the creditors, I guess, right? So Madhushri, Vrinda responding with a cash balance. That's okay. Vrinda, those are the things for the cash budget. But my question was whether we need to do some working before actually going to the actual cash, budget over there, right? Pooja is asking why not payments to creditor and payments for cash purchase is both credit and cash, including this payment for purchase. That's okay. That is fine. See, what I'm trying to say is that I think, Pooja, what I differentiated was probably if you see from a receipts perspective, we are talking about receipts from debtors and cash sales. So both are related to sales only. Na? Similarly, for purchases, it could be an immediate month or it could be a credit payment to the creditors. Like in this example, I don't see any information with respect to any cash purchases. So all the purchases are credit. So we will be flexible based on the information given to us in the question. So guys, I want you guys to just quickly do one thing. Take a snapshot of the screen right now, and we can move on. And you guys can help me off when we'll be preparing a cash budget. But we need to do some working here. So let's move on to the different screen here. Now, in this case, if you're looking at the information from April to September, so I think we need to do some workings here. Let's say my working note 1 is a collection from debtors, guys. We need to calculate the collection from debtors and also the cash sales, of course. Okay, so now in this case, let's see, we have some cash sales also, and we have collections also. When I'm looking at the numbers from the collections, guys, we are looking at 20% cash and 80% credit. And the credit sales are talking about within 1 month and the balance in the month of the second month after the sale. That means, guys, what will be the collections for the April month? I'm just kind of thinking from an example perspective. What do you think? What do you think will be the April month's collections? Ultimately, we'll be needing April, May, June, July, and accordingly, we're talking about August and September. Just give me a second. So what will be the April month's collections? So let's talk about cash sales here. First of all, I guess everyone with me that we will be needing cash sales for every. So 20% are anyways the cash sales, if I'm not wrong, right? That is something anyways we have the cash sales. So 20% of April, that is 16,000, 12,000, 16,000, and so on, right? So cash sales were 20%. Now this is for a respective month, by the way. 16,000, I guess 12, 16. And in the July, August, September, we are having a 20, 16, and 12. Can you please double check, guys? I hope we are on the same page on this. Now we talk about moving on to the credit sales here. Now credit sales are 80%, right? And probably we can mention the credit sales for, let's say, in April month. So guys, the credit sales collection is actually talking about in terms of spreading into 2 months, I guess. We are saying that, okay, 75% of the credit sales are collected in 1 month and the balance in the second month. So in the April month, that means we are receiving for the March and Feb, guys. So in the April months, we have a March and Feb. So let's say, let's note down February and March numbers here in terms of credit sales, guys. What will my credit sales? 80% credit sales. So we're looking at 96,000. And 112. And accordingly for the later on months. So we are just noting down these sales quickly so that we can calculate our collections accordingly. So 80% what we have. Now, from the collections perspective, what will be the amount to be collected in the month of April? So we're talking about, okay, 75% of the last month, previous month, and 25% of the second previous month. Make sense, guys? So that means in April, we're talking about 75% of 112, like 112, guys. So what is that? So we're looking at 75% of this amount. That means we're looking at 84,000 collections and 25% of this amount, which seems to be 24,000 to us. Everyone with me on this, guys? I hope this is clear to all of you. Okay. So accordingly, I think we can proceed on for the next few months as well, right? So we're looking at a 75%, that is a 48 and a 28,000. Similarly, in the month of June, we are taking a May and April, guys. 36 and a 16. I hope everyone perfectly fine till this stage. So you have calculated a cash sales and the cash collections. So let's say a total collections is how much from the debtors. So that's a 1,08,000, a 76,000, 52, 60, 76 and 68, guys. That's how it seems to be. So that means my total cash sales is the first top line, and then we have the bottom line as the total cash collections. Okay, so any thoughts, guys? I hope this is clear to all of you. Now, if I'm looking at the question quickly, we are talking about purchases amount to 80% of the sales and are made on credit and paid in the month preceding the sales, guys. So what do you think? That means 80% of the sales and the made in on credit and paid in the month preceding the sales. What do you mean by that, guys? So in the April month, what would be the payment to the creditors? Can anyone tell me? Are we looking at May sales? Am I correct? Are we looking at May sales, guys? Yes or no? So we need to understand the language over there, right? So the next month's sales, 80% of that will be the purchases that will be making the payment in the current month here. Okay, so I think let's do one thing. We may not be doing a separate table for that. Probably we can quickly create a cash budget. That means, so let's do a cash budget for these 6 months. So we are talking about April, May, June, July, August, and September. Guys, I think we can start this with the beginning balance. I think the beginning balance which is given to us, and I hope you guys know one thing, that ending balance is also given to us. Am I correct, guys? Am I correct that the ending balance is also given to us? Looking at the call of the question. Okay, I can see some responses. Charu saying, okay, yeah, Charu, this is basically from the study module. That's okay. Need to divide cash. That's okay. Okay, great. So I think everyone has confirmed that this is absolutely perfect till now. So our beginning balance is 20,000, but I think the ending balance will also be 20,000 as well, right? So let's talk about receipts now. Now receipts we had cash sales and the debtors collections. So let's talk about cash sales and debtors collections. So our cash sales, as we just calculated on the top, are a 16, and we're looking at a 1,08,000 as a debtors collection. Guys, any other collection other than these? I think that's okay, right? We don't have any other information. So that means my total receipts or my total cash for this month is 1,44,000. My question to you: can I simultaneously, kind of probably make a noting for other months? I guess there is no harm, because in this case, one thing is for sure. If you guys agree with me, if you don't agree with me, probably you can ask the question, definitely. But I think in this particular question, since we are talking about ending balance has to be 20, so that means every month's beginning balance we know in advance. That has to be the case. We don't have a choice here. So that means we can probably do this quickly. Everyone can quickly do this calculation. So you're looking at a cash sales and the collections for all the months in this case. That's it. The only thing we need to calculate is probably, okay, are we looking at a temporary investment or are we looking at a borrowing overall, right? But also we need to ensure while the payment is being made, there could be different months having some different specific payments. I think that we will be discussing based on the information given to us in the question here. Okay. Madhushri has a question: why the 20,000 opening balance for all the months? Madhushri, because if you see the question there, the question has given us, the illustration has given us the fact that, just give me a second, that there has to be the 20,000 beginning balance, which is minimum desired level of cash balance. Any cash surplus deficit is made by the temporary investment or liquidation of temporary investment. Right? So if you have a surplus, you make the temporary investment, you will keep 20 with you. And if you have a shortfall, you will either liquidate or borrow. That's it. So they have given that in the bottom line of the question itself. Now, can anyone tell me in terms of the payments, what do we have, guys? I think we also make a quick note on the payment side. So payments with respect to the purchases first. So we know that there were sales given to us, guys. So May sale is 60,000. So 60,000 into 80%. So we are looking at the payments as a 48. Similarly, for June we have 80. So that will be paid 80%. So I think we can mention that here, 80% of the next month sales. That's what we are doing here. Everyone with me, guys? So 48, and then we have a 64, and accordingly we can quickly check. So July, that's why we needed information till October, by the way. So 80,000. Anyone having any doubt how we are calculating the payment of the purchases, guys? We are looking at the next month sales and we are multiplying that by 80%. That's what we are doing. I hope everyone with me on this. And I hope your doubt was clear with respect to the 20,000. Madhushri, I hope that is okay. Any other payments, guys, apart from the purchases? I think now we are very much close to completely solve this. They're talking about some expenses also, I guess. They've given some wages, right? So wages is anyways given in the question. So they're looking at a 9, 8, 10, 10, 9, 9. That's anyways given to us. So that's not an issue here. That's anyways given. And apart from that, I guess we had something else. I think we have interest on debentures quarterly in January and April. So 10% is so interest on debentures. Guys, how much amount do we need to pay interest on debentures, guys? There are 10% debentures of 1,20,000. So yearly interest comes out to be at 12,000, guys. And they're asking us to make a payment quarterly. Are we looking at a 3,000 every quarter, guys? So that means 1,20,000 into 10%. That is for quarterly. And I think, let me check what was the date. So January, April, and so on. So that means the next one would be July probably. So for us, this is a 3,000. There is nothing going in, and there is a 3,000 here. Guys, I hope everyone with me on this. And then there is a advance tax payment also, income tax. Income tax advance. They were talking about the 5,000 payment needs to be made in July. Anything else also, guys? I think we are done. Probably we can just check quickly whether we have a sufficient balance or a surplus balance or a deficit balance. We'll see that there are different possibilities, but let's quickly add up the total payments. So we have a total payments here. 60, 72, 90, 82, 57, and 89. Guys, any thoughts? Any thoughts till now? Any questions? Okay, Madhuli, which is the area you have a doubt? Which calculation you want to understand? Wages are given to us. Interest on debenture I have just calculated, and the purchases are the next month sales 80%. Yes, Sandeep, that's absolutely okay. Now, guys, what is the ending balance we needed? Can anyone tell me? Sorry, a very basic question I'm asking again. I guess ending balance, we know, we can say that ending balance required is a 20,000 here. In all the months. And let us say in actual, disregarding this, 20,000, let's say that we need to have this 20,000 with us. Do we have a surplus or a deficit? Let's say we have 20,000. Okay. Let's say whether do we have a surplus or a deficit. So let's write down a deficit in the brackets. So 144 for the April was the receipts, and you had a payments of 60, so 84, and you need 20 guys, so 84. So let's see a quick check here. Let's say this is A, this is a B, and this is a C. So what I'm mentioning here is a surplus or a deficit is A minus B minus C. So surplus, so we have a positive number here, 64,000, 64. And then we have 16,000 on this side. We have a negative number here. What is the negative number here? 64, 16, and then we have 22, I guess. In the month of July, you are having a shortfall of 2,000, I guess. And then we have a positive number of 35. And then again a shortfall of 9,000. Can anyone tell me what does these positive numbers and negative numbers imply here? What does the positive and negative numbers imply? We are preparing a cash budget. What do you mean by surplus or a deficit? I think that's given in the question, right? So the action here is, Mansha, sorry, I probably did not see your question. I missed that. Mansha said, are these estimated sales risk adjusted? The probability of these estimated is 0.5. I think you're using the concept of expected, if I'm not wrong. So if they have given us the different probabilities, then definitely. But if you look at the information given to us, in that case, they have not given any probabilities to us. Okay. I just saw your doubt now. Okay, Madhuli, the working note credit and cash sales, if you want to just quickly understand, if you see that cash sales were 20% for the sales for the respective month. Now, if you look at the arrows from the April month's collection, so 80% is the credit sales. In the month of April, you are getting a 75% of the collections from March and 25% from Feb. And that's how for the every month we are doing. I can connect those with different arrows, but otherwise you'll not be able to read these numbers. That's why just, for example, I've just used these arrows for April collections, guys. 75% of the, look at this, 75% of the previous month and 25% of the second previous month's credit sales. That's what we have done. Rakesh says we have prepared a income expenditure statement instead of budget. Why, Rakesh? Because it is not income. This is a cash payments and cash receipts. If you're talking about the income statement or income expenditure budget, then we would have followed accrual. We're not following accrual right now. We're following cash basis. Okay. So that means I think I can see some responses here. So let's say what is the point of action here? So action item for the positive numbers, guys. So what is my point of action here? So if you're looking at a positive number and a negative number, I think they've given us that temporary investment and or we're talking about a borrowing, right? So the action items is do the investment here, investment and investment. In the negative numbers, we are looking at a sale of investment or borrowing. And similarly here also. Make sense, everyone? I think that's what you guys told me just now. Pooja, which one you are talking about? Saurabh says, please check April. Okay, what's happening in April? I think that's okay, right? I don't see there is a calculation error at least here. I think this is okay. Right? And Pooja, where exactly you're talking about percentage? I think percentage were anyways mentioned, right? 75% and 25%. We mentioned that over there. So we had already mentioned the percentage in the credit collections. So guys, I hope everyone with me on this. Everyone okay? How to go about the cash budget over there? Any doubts, please let me know. And if it is clear to all of you, kindly confirm. Acha, okay. That's okay, Pooja. Okay, so I hope everyone clear, right? So let's move on and see what do we have here, right? So we had a similar outcome on the right hand side. So we're looking at this is the course of action we're talking about at the end. And as I said, guys, this is not an income expenditure over here. We are looking at receipts and we are looking at payments. So we're talking about more from a cash basis. This is a cash budget. Good question, Vasu. I think we have been a little slow because I was explaining you simultaneously, but I think if you honestly ask me, probably 10 to 15 minutes at max. I think like once you practice it, I guess you will get the time management. Okay. So quickly, we have another exercise here. Last one was basically a kind of laying down a foundation. How do we go about this? So here we're talking about some information given to us. Based on that, we have to prepare a cash budget. Again, a similar one. So let's see what do we have here. So the requirement is 3 months budget for this one. 3 months budget, that is 3 months ending 31st March. And they have given us the working capital at 1st January will be as follows. Cash in bank, short-term investment, debtors, stock, creditors, other creditors, and other payments as well. Now, they're given a budgeted profit statement for 3 months, net profit before tax, depreciation of 60,000 is included in the budgeted expenditure. That's interesting. That's very important for us to know. And they have also given us budgeted balances at the end of each month, guys. At the end of each month. So what we are required to calculate is a cash budget over here. I think probably a much better example here, or in terms of how do we go about this, But this could be a little tricky because in this one, I think we don't have all the information handy with us. We might need to do a quick calculation for certain aspects. Can anyone tell me what are the calculations required here? What are the calculations required here? Because I think if you can see that they have given you the balances for our debtors here. So we have an opening balance of debtors. We have an opening balance of creditors. And then for every month, you have again the balance of the creditors and debtors given to us. Make sense, guys? So I think there is a little bit of a work required on this one. So there is a requirement of a little bit of a working on this one as well. Not only that, there are different balances of other aspects as well. Mansha has a very, very interesting point. Finance manager will give preference to borrowing instead of sale. Absolutely. I think leverage effect, and Mansha, if you agree with me, I would like to add that probably you don't want to lose the speculation advantage of the temporary arbitrage movements of the investment values. So both the factors would be there. That's absolutely good. So we're talking about the financial leverage impact, but again, that depends on the existing borrowings. But definitely, if you have a holding where you see a profitable opportunity, why not, right? But anyway, so let's talk about this one then, guys. Now, this could be an interesting question here, and we need to understand that, okay, what all we need to calculate here. Do we have purchases, by the way, before we even talk about the payments over here? They've given us investment, so sales, cost of sales. They have given us the stock value. So I think probably in this case, we need to do a little bit of a homework, even more than what we did in the last one. We need to calculate the purchases, the payments to the creditors, and not only that, we might need to calculate the debtors collections as well. And then accordingly, we can quickly go for a preparation of the cash budget. So this is an interesting one. So let's have a quick attack on this one, all of us. And I request you all to kindly just take a snapshot of this one while we can quickly look to solve this. Okay. Charu, yes, we need to calculate that for every month. So let's do that as well. So I think the first point is, as we did in the last question, probably we need to quickly understand that, okay, hey, we are talking about 3 months, but are we talking about any kind of sales and so let's talk about a working note. That is where we'll be talking about calculation of the payments to the creditors and collections. So we are talking about both the aspects here. So first of all, I think for the collections piece, I think for that we have information given to us easily. We have debtors balance, sales, and the closing balance that could easily tell us what's happening in each of the months, right? So let's talk about that first. Jan, Feb, and March. Guys, I hope we understand the basic P account here. So we're talking about in terms of the collections first. In this case, we have a beginning, debtors. So what is the beginning debtors given to us, guys? I think we had a 2570. So we have a 2570. And for the Feb and March will be the ending numbers of the previous month. So 2600 and a 2500. So that's what we have. And from the income statement, we can easily plot in the sales. So that's the sales with us, 2100, 1800, and a 1700. And then we have a ending balance. So ending balance would be given to us as is 2600, 2500, and we are looking at a 2350. So that means the collections part is pretty straightforward. So what's the collection we're talking about? 2070 and 1900 here and 1850, guys. Guys, can we double check, please? Everyone is with me here. Can we double check this, please? Madhushi, need to check the number though. I'm not sure of the number. I think you can check that later. Right now, we can concentrate on pretty much going about this. Okay, so guys, what do we do for the payments to creditors? We have beginning balances and ending balances, but do we have the purchases with us? Do we have the purchases, guys? So let's attack on that as well. How do we calculate the purchases, by the way? Before we even go for the payments, I think for the purchases, they have given something to us in the question that would be helpful, right? So let's quickly talk about this before. We know the COGS is the opening stock plus purchases minus closing stock, guys. Everyone with me on this? Hence, can we say that a purchases will be a COGS minus opening stock plus closing stock? Any doubts on this one, guys? I hope this is clear to everyone. So we need to quickly do a purchases calculation. So what is the COGS given to us, guys? From the income statement, I'll be little quick here. So looking at our 1635, 1405, and third month given to us is 1330. And then we have closing stock. $1,200, $1,100, and 1,000. And the opening stock has to be reduced from this. $1,300. $1,200 and $1,100. So what we get is in terms of purchases. Everyone with me on this, guys? Till this point, everyone is in control, I hope. Once we have purchases, I think then it becomes a pretty straightforward job to quickly calculate the payments. So we have purchases. I guess we need to quickly see that what will be my beginning creditors. So my beginning creditors are 2110, 2000, and 1950. So the beginning creditors for the next 2 months will be the ending creditors for the first 2 months, right? And then we have ending creditors. That will be again a reduction for us because that's a balance outstanding. So the difference would have been the payment, guys. So that is pretty straightforward. We are talking about a 2000 and a 1950. And of course, for the third month, they're given us as a 1900 in the question itself. So what we are getting here is the payments. So payments to creditors. So that's coming to be 1645 if I'm not wrong. 1645. Here we get a 1355 and probably a 1280. That's a quick calculation, guys. Okay, Pooja has a question. How did I get an opening balance for Feb and March? Opening balance for the Feb and March, Pooja, is the ending balance for Jan and Feb. So let me draw some connection arrows over there. So this is what is going to be the opening balance, right? Both for, in fact, for, generally for both debtors and creditors. And similarly, if we're looking at a closing stock over here, look at this. So this closing stock becomes the opening stock here from a stock perspective, and that also. I hope this connection is helpful for everyone. Okay, so guys, I think now we have the collections and the payments. I think we need some more information, but it's probably better that we can do that working once we have the cash budget with us, right? Because there are a lot other balances given to us in the question itself. Let's say a simple example, if I'm looking at that particular question here, and I'm sure you are also looking on that. In case you're not, let me go back to the screen quickly. So there are a lot of other information as well. Let's say you're talking about a short-term investment of a 300, and then you have a different balances every month. So we have to take that into account. There could be more investment, less investment. So if there is an increase in investment, there is a negative, there is a payment. And if there is a reduction in investment, that means we have sold the investment. Similarly, we have the dividend payable information, tax due information, and even the plant information as well. So all those aspects have to be considered in terms of the cash budget. So one point is that probably you could make some more working notes. Probably when you practice, it is advisable to do that. Make some working notes, create what are the movements in investments, dividends, taxes, even the assets. So that could be one thing. And of course, what we'll do is we'll probably prepare a cash budget, and we'll see that how those workings can be done simultaneously. So we're looking at a cash budget now quickly. So we have again Jan, Feb, and March. So do we have opening balances? Yes, we have, of course. So we have a 545. And do we have any other balance with us, or do we need one in this case? I don't know. That's what your job is, right? So we need to calculate what are the other balances. Of course, we know that the ending balance of the first month becomes the beginning balance of the next month, guys. So don't forget. So we don't need a beginning balance for all the months probably here. And if the question is kind enough to give that, so probably you have something to check your answer with, right? So need to be careful here, right? So that means your subsequent month's cash budget depends on what you do in the first month, right? So so we have a beginning balance here. Now, first, let's quickly talk about the collections. Now, collections, we're talking about debtors first. So what were the debtors collections here? I think 2070, 1900, and 1850. So we can plot that quickly for all the months here. Now, guys, if we look at the other information given to us in the question, I can quickly see that, hey, there is a investment balance that was in the beginning was a 300. It increased to 700, and in the Feb it decreased. So that means probably in the month of January, I'm looking at only the investment, guys. Please listen to me carefully. I'm looking at only the investments right now. So let's do one thing. Probably we just kind of make some space here. So let's talk about payments at somewhere here. And we will have the creditors payments noted down shortly. But what I'm liking to see here is there could be a possibility that there is a sale of investment, and there could be a possibility of a purchase of investment as well. Because if I'm looking at a investment account itself, that's it. So what were the payments to the creditors, guys? We can just quickly get that done also. 1645. 1355 and a 1280. So now let's focus on investment here. Initially, the short-term investment increased from 300 to 700. What does that mean, guys? That means probably you had a 400 up purchase. So 300 to 700, you purchased 400 investment more. That's a payment over here. In the second month, you moved from investment of a 700 to 0. That means you are selling an investment of a 700 here. Sorry, not. So let's mention over here. So 700 sale of investment. Okay. Okay. So now we are looking at what are the other accounts given to us. Guys, what about dividends payable? There are other creditors also. Look at the other creditors, by the way. Other creditors are 200 standard. So do we need to do any adjustment for the other creditors? I don't think so. I don't think so. But because the other creditors remain at 200. So probably the regular accrual and regular payments probably would be there, but there is no change. So we are not making into account, right? So let's move on to the dividends payable then. I think we have a dividends payable of 485 that went to 0 in Feb. So guys, when was the dividends paid? Can anyone tell me here? When were the dividends paid, guys? In which month should I plot the dividend payment? Because dividend payment got 0 actually from a 485. So which month the dividends were paid? I think Feb, right? So we're looking at a Feb because in the Feb, the dividend got reduced to a 0 over there. And similarly, do we have any kind of a changes in terms of taxes, guys? Any changes in terms of taxes? Not sure, right? So we are looking at a tax due of a 320 in across all the months. So we are only left with probably looking at the plant aspect. So if you are looking at plant, we have a 800 balance, and then we are looking at a scenario of 800 moving to a 1600 and a 1550, guys. 800 moved to a 1600 and then a 1550. That means probably there was a plant purchase and then as well a sale of the plant as well, right? So when the 800 moved to 1600, so we're talking about purchase of plant. So that is 1600 minus 1800 here. That happened in the month of Feb. So that's 800. And then from a 1600, we talk about 1550 in the month of March. So sale of plant of 50 over here, guys. Anything else? I guess we are done here. Or something else we need to mention? Guys, what about the expenses? Don't forget that piece. Madhushi says purchase of investment in March. Okay, great. So purchase of investment in March. Great, Madhushi. So March, May, we had a 200 investment purchase. So let's mention that. And I think one more thing is we need to mention is expenses, guys. So we had 315, 270 and 255. Guys, should we mention as is? Should we take the expenses as is, guys? Can anyone tell me? In the P&L, we have expenses. We have expenses over there. Should we mention the expenses as is from the P&L? The SG&A and the other expenses, guys? In the payments, what do we mention for payments? Other expenses. Should we pick the direct expense here because in absence of any information, or should we need to do some adjustment? Charu, yeah, we did that. Thanks for notifying Charu and Madhushri. We did that. We notified the March investment. Good that you guys are active. And guys, just give me a couple of minutes more. We will be taking a break after 2-3 minutes once we complete this. Okay, so Charu says the expenses include depreciation. So we should reduce the 60,000 depreciation from all the months. So let's say a 315, it gets reduced to a 255, guys. So other expenses excluding depreciation. So depreciation has to be excluded. So 255. Now the Feb month expenditures are 270. I mentioned 210 here. And similarly, the March month is 195. These are the expenses, guys, we have here. Make sense, everyone? So if that is the case, let's quickly see what are the total payments here and what are the total receipts. So payments total comes to be, is it a 2300 here? 2850. And in this case, we seem to have 1675. And what about the total over this side? So that means we have 2615. And having said that, we can quickly plot in the ending balance as well, because we need to complete it quickly. So ending balance seems to be 315. Let's say this is A, this is B. So we are mentioning A minus B in this case. So we're having a 315. So 315 ending balance, which we just calculated, guys. That is what we will be plotting up in the beginning of Feb. Beginning of Feb. So in this case, we don't have any other information with respect to the temporary investment and all. Yes, Mansha, we did that. Yeah. Meman has a question: how to get 700? Meman, because my investment was sold, na? 700 to 0, and that's why we said sale of investment. Okay. Now, what is the next month balance? 65, I guess. We are left with 65. That's very, very close here. 1965, and that means 290 seems to be my ending balance here. So that completely wraps this question here. I think this one was a little bit of a tricky one, but I think a good exercise on how to prepare a cash budget. I guess everyone is pretty much clear, right? So let's do one thing, guys. Probably right now is what we have at almost 7:23. So you guys can have a quick look at the solutioning. As I promised that I would be uploading the solutions file after our sessions, but now since we have another session on Saturday, so I will be doing that later on. Madhushri, we have reduced the depreciation from other expenses, right? So that's what we did. We reduced the depreciation from other expenses. Yes, Sandeep, absolutely wonderful. So yeah, so guys, that is good. Good job, everyone. Everyone was super active, and you guys were with me. I can see that from your responses. So let's do one thing. Let's take a quick 10 minutes break now, and after the break, we'll come back and just quickly talk about the long-term budget. We'll just not spend too much on that, and then I will be moving on to a little bit of some aspects of the floats, right? So let's take a 10 minutes break here, and we come back and proceed from here, guys. So see you in 10 minutes. Yes. Okay, guys, so welcome back. I was looking at one of the questions from the previous illustration from Madhushri. Madhushri, we did not include other creditors because the ending and the beginning balances were the same, right? In the creditors, we had the other creditors were 200 throughout, so there was no change in their balance. Okay, that's the reason. Okay, guys. So now moving on, we talk about a couple of examples on the short-term budget. With the long-term budgeting, as I said, it's we need to probably go for towards an aspect of adjusting our income statement. So what we are doing here is we have to calculate the cash in bank at the beginning of the year, and we have to do certain adjustments. Like, of course, we have the income statement where we have the profit before tax. We add back the non-cash items like depreciation. We add the we incorporate the investing and financing sections. We're talking about, okay, adding the sales from the assets here, or even the financing aspect of the money coming in from shares or debentures, changes in working capital. So like we do in a cash flow, probably indirect method, and then any kind of a dividend and tax payment, again, investing activities or redemption of shares or debentures. So all those aspects are to be done for a longer period, cash budget over here. Okay, so let's quickly look at a situation here. So we are talking about, in this case, P&L for 2 years. So we're talking about long-term budget here. That means we're talking about 2 years. Sales are expected to be 12 crores in the year 3. As a result, other expenses will increase by 50 lakhs. Only raw materials are in stock. Assume sales and purchase are in cash terms here. And the closing stock is expected to go up by the same amount as between year 1 and 2. Okay, so the company can use 75% of the cash to generate cash generated to service a loan. And the question is, how much cash from operations will be available for year 3 for the sale? Guys, any thoughts? What needs to be done here? What needs to be done? So probably we need to calculate the year. So I think the starting point would be, in this case, probably to calculate a year 3 P&L for us. That should be the point we need to know. So 1200 crores anyways is something which we know. Okay, 1200 or rather 12 crores, not 1200 crores. So 12 crores, if we are looking at a situation in the sense of sales, in this case, the key point would be the line which we're saying that the closing stock is expected to go up by the same amount as between year 1 and year 2. Now we are looking at a consistent change in the closing stock, guys. It's important to understand that, and only raw material is only in the stock. So if I'm talking about a consistency in the closing stock, guys, don't you think? And if we have only raw material, probably we need to incorporate the changes in the stock balance, guys. And how do we do that? How do we do that? Any thoughts? So we could do a calculation of cost of sales or cost of goods sold, maybe, because they are saying that, okay, they have to be going up with the same amount between year 1 and 2. So as between 1 and 2. So what we can do is probably we can calculate the amount consumed. Let's say we are looking at a situation of year 2. In year 2, what is the cost of goods sold, guys? So we have 1 CR, or then we are looking at a 4 CR, that is a raw materials purchase, and a closing stock of a 1.5. So that means, with respect to the sales, can we say that what was the ratio in terms of the consumption, guys? Any thoughts? So if you're looking at the similar jump, we can calculate the thing here between year 2 to year 3. So let's say in year 2, what is my COGS, or rather not COGS, I would say the materials consumed. The materials consumed. So we have 1 crore here plus 4 and we are talking about minus 1.5. So we're looking at a 3.5, and we have a sales with us for year 2, that is a 10 CR. That means we're looking at a 35%. And if I'm saying that, okay, the movement has to be a similar in terms of year 2 to year 3. So probably we can calculate that, hey, my materials consumed for year 3 could be a 12 CR into a 35%. Can anyone tell me what is that amount? What is that amount coming out to be? So 12 CR into 35%. So we're looking at a 420, right? Or a 4.2. So we're looking at a 4.2 CR. So that's what the material consumed is. And anything else we are given here? Expenses will be changed or increased by 50,000. So we have expenses that is given to us as 1 CR. So we're looking at a 150, then 1.5, and everything else remains the same. Am I correct, guys? Everything else remains the same. So let's do a quick calculation here, and then probably we can have a look at how to go about this. So for the year 3, I'm just doing a quick mathematics here on the screen itself. For the year 3, my sales is given to us as a 1200. Then we are looking at, okay, we just calculated my material consumed is 420, 4.2 CR. So that means 1200 minus 420. This is material consumed. What about the stores, guys? Anything about the stores? Okay, there is a request coming in from Charu and Brinda. Can you please repeat this? So Charu and Brinda, what did we do is we calculated the raw material consumed for year 2. That is opening stock plus raw materials purchased minus closing stock. And we calculate a percentage over the sales. So we got 35% consumed with respect to the sales. And we use the same ratio. We use the same ratio for year 3 as well. That's what we did. Probably you could check. I think in the year 1 also should have been the same. If that's what they are given the question, right? Let's quickly check year 1 mein what happened. 3.8. So 380. Let's say these are in lakhs. So 280. So 280 upon 800. Is it 35% guys by any chance? I think it is, right? It's 35%. So I hope, so we're using year 1, year 2, what was happening was 35% was the maintained amount, and on that basis we calculated the year 3 as well. Great. Charu, thanks for confirming. Now we have a sales and we have a 420 in terms of the material consumed. What about the stores? Do we have any information about the stores, guys? So I think they have given us in terms of the stores increase. So probably we can see that the same jump can be there with respect to the stores as well. So what was the jump in terms of sales, guys? We are preparing a budget, right? So we are seeing a 20% jump in the sales. So if my stores were 120, that means for the stores for the 3rd year would be a 120 plus 20%. That looks to be a 144. So this is my stores, right? And then you are talking about manufacturing expenses. What would be the manufacturing expenses? Again, a 20% jump on 160. That means 20% into 160 would be 32. So we're looking at a 192. And other expenses, they have given minus 150. Ideally, in a nutshell, probably this should be my cash, information given to us. On the basis of information given to us, this should be the number which we are targeting here. So can anyone tell me what is the amount we have here? So this is more of a adjusted net income. I should not even use the word cash yet, but what would be the adjusted net income right now? So we're looking at a few numbers, which is a 1200, 420. and we are looking at a further reduction of other expenses as well. So I guess we are getting a 294. So a 294 seems to be a adjusted net income for year 3. But will that be the amount with respect to the cash budget as well? The requirement is the 75% of the cash generated to service a loan. So that means we need to calculate the cash, and then probably we need to calculate the 75% of cash that could be used for servicing a loan here, right? So is 294 cash, or we need to do any other adjustment, guys? If you look at the last slide, we're talking about some adjustments here. So profit before tax, we added back the depreciation. Any sales proceeds for the assets, I don't know. We don't have any information. Any issue of the shares, debentures, redemption, nothing else. But my question is, do we have anything with respect to reduction or increase in working capital? Any component of the working capital, guys, in this particular question? Any component, guys, in terms of the working capital aspect? Any thoughts? Okay, 294 wali statement. Okay. Charu says, what is 294? Charu, 294 is nothing but net profit adjusted for the depreciation. Manufacturing expense, Sandeep, they're given, okay, so I think there is a common doubt coming in. Manufacturing expense and other expenses, what I've done is I've just added 20%. How the 20% is coming up? Because my sales are given to be at 12 crores in this case. And there was a 10 CR last year. So we basically 20% addition. That's it. I hope that solves all the doubts related to this. Okay, but my question is, any adjustment we need to do for any kind of a working capital related? Anything with respect to the working capital, guys? So we are looking at manufacturing expenses, other expenses, 20% increase. But what about the other items? This is thus the net adjustment. My question to you is, think logically that my cost of materials consumed in this case was 420. What was that in the last year, guys? What was that in the last year? 350. The last year was 350. So there was a change from a 350 to 420. So year 2 and year 3. What is the cost of a material consumed? 350 to 420 here. Also in the information of the question, they have given us that the closing stock is expected to go up by the same amount as between year 1 and year 2. So can I say my cost of material consumed is okay, opening stock plus purchases minus the closing stock, that's okay. But can I say that year 3 closing stock will be 150 plus 50, guys? That will be 200. Brinda is asking me about how 192. Brinda, 192 is manufacturing expenses, 160 plus 20%. How 20%? Because what we did was increase in sales is a 20% here. From a 10 CR, you are going for a 12 CR. A 20% sale. So we added that to the manufacturing expense and to other expenses. What I'm right now explaining to you guys is we need to understand that there was an adjustment to the working capital as well. So any reduction should be added. Any increase in working capital should be reduced. And you know that from the cash flow statement concepts, if there is an inventory increase, guys, is it a cash inflow or an outflow? Is there a cash inflow or outflow, guys? If there is an inventory increase, is there a cash inflow or outflow? We are not making a cash flow statement, mind you. We are making an income statement. We are making an income statement, and in that, probably what we are doing is we're just adjusting for the changes in the working capital. Someone said how to get a 150. 150 is guys, there are other expenses which are given to us, right? Oh, sorry, I think my bad. I think that's why you are saying this. So let me do this. This is not 20%. Let me just rewrite this. So this is a 50. This is a 50 which is given to us, 50 lakhs. So some people are asking how that 150 is coming up, that 50 lakh, right? So what we did was actually I wanted to write 20% instead for the stores. So 20% was increase in the stores and the 20% increase in the manufacturing expenses. I hope that is okay, Meman. I hope everyone is okay now. So that 20% was inadvertently mentioned in the wrong row. That was for stores and manufacturing expenses. Okay. Calculations are absolutely correct, guys. No issues in that. So yeah, so everyone is okay that, okay, if there is an increase in inventory, there has to be a reduction in the cash. That means my actual cash flow will be less than 294. So if my adjusted net profit was 294 without depreciation, so 294 minus 50, that means we are looking at that as an amount over there in nutshell. Guys, can you just double check the calculation here? If you are all getting 294 or there is some issue, because I think one student mentioned a amount different. Is it a 294 or something else? Okay, I think, is there anything we are missing, guys? Is there anything we are missing here? Okay, Vasu has a doubt. Calculation of stores in comparison to year one. The sales increased by 25% in year two. That's okay. In year two, but the stores increased by 20%. Okay. So Vasu, we are basing the information in year three based the year two, not year one, unless they have given any other information. Because if you can see, it's only for the inventory they have said that the amount is equivalent increase from year one to year two and year two to year three. For anything else, they have not mentioned anything. So we have based only year two. We have not based year one. One more thing, guys, if you guys just quickly check, there was another aspect which is given us either as a miscellaneous income. So I think that needs to be added as well. So miscellaneous income also needs to be added. So we're looking at a total adjusted profit of a 304, and then there has to be adjustment for working capital, right? Yes, Madhushri, we just added a miscellaneous income as well. That's what we did just now. Okay. So let's quickly look at the solution here. So I think we got a 304, but here we are looking at a 204 net profit because we will add back the depreciation to get 304. So that's what we did also. But I think now you are in a better position because I have explained to you various aspects, how we are kind of increasing that by respective aspects. Okay. And I think that also answers the question to you, Vasu, because your question was year one and year two. Can you see that alternatively, you could do a percentage of sales as well? So let us see that, what you can see on the point number 2 and 3 at the bottom. That percentage will remain same now, because if I am including year 2 as a base, whatever the percentage in year 2 will be in year 3. So I think that percentage could also be a good connect to check, right? Alternatively. And if you want, you can probably check if there was a similar percentage there also, that's okay. If you just want to check, but I would say that even they have maintained on the year 2 as well, right? So we talk about as a year 2 sales and we talk about the year 2 expense plus 20%. We use the same. So alternatively, whichever route is more comfortable for you guys to understand, I'm okay with that, right? But the point is, the most important point is, this is not a cash, cash budget. This is adjusted or a projected P&L, guys. Please respect the title here. We are looking at a P&L only. You're just projecting the P&L only. So for the cash flow, we'll be making some adjustments. So we have a 204 profit, and we are adding back the depreciation, and we are adjusting for the cash or any kind of a working capital adjustment. So in this case, I think we arrived at a 304, and then there was an outflow as you guys have suggested. But remember, if there are any kind of a purchase or sale of non-current assets, or any kind of issue or a redemption of shares and debentures, so all those will also be adjusted here, guys. All those will also be adjusted. This is a long. Yeah, of course, you need to just go back after the class. You can just probably look at just another reading of it, and probably I think you will be getting more comfortable on this one. Okay, so I think we need to move on from cash budget, guys. Now, the next area which I want to touch base upon is how does the efficiency in the process can help into managing my cash collections and disbursements. Now, any organization would have some objective in terms of the cash collections and disbursements, and those objectives are clearly we need to speed up the collections and we need to delay the payments. But my question is, can you delay a payment beyond a point, guys? Yes or no? The question is, can you delay a payment beyond a point? And can you ask the payment too early? We discussed that in the last class, right? We discussed this aspect in the last class. See, you can't delay the payment beyond the due date, I guess, right? Because then you will lose the goodwill. You will lose the relationship with the supplier. Charu, we just talked about the working capital adjustment because the increase in stock will result in a cash outflow, like we do in a cash flow statement. Okay, so coming back, I was asking you a question. So I think everyone agrees with me that we can't delay the payment beyond a point, and we can't ask the collections too early. See, simple point is that, there are competitors, right? There are competitors in the market. If you want to ask payments too early, reduce the credit terms, that's what we discussed in the last class. Now, the reason is why we need to accelerate the payment and accelerate the collection and defer the payments is because generally there is a gap between sales and realization of funds. I think you guys also know that's something we discuss, operating cycle, right? But in between the payment, we're talking about floats. Floats means a kind of a delay or a time gap between, probably the time when you actually sell the goods and actually collect from the debtors, right? That's why probably you would like to defer the payments also. Now, one is called the billing float. This is something which is related to the internal processes. Let's say if you are selling the goods. Now, these days, I think everyone agree with me on this that, as soon as you make the sale, you generate the invoice. So these float concepts are a little bit traditional in nature. In a modern day era, you will see that, there have been exercises that any type of floats is actually literally gone. Probably in a smaller or a private enterprises, you might still see one of these floats. So what is billing float? If you are selling the goods and actually not sending the invoice along. These days, if you have online shopping or even if you're shipping the goods, you definitely send the invoice simultaneously. This is basically a more of an internal processes. So of course, if that is sorted out, there should not be any billing float ideally. Then there is something called mail float. Now, imagine that the person sending you the check by the courier. Do we get the payments from the customers these days by that means, guys? I think we have modern day techniques. We'll touch base upon that a little later on, like let's say NEFT, right? Online money transfers. So of course, if you're talking about a mail float, that means if someone is carrying your check, that would be your delivery agency. That's a mail float here. Check processing float is something. Okay, now let's talk about this. Let's say still there are smaller enterprises. If they are still making the payments with the checks, I hope you understand that yes, there has to be a proper clearing time with respect to that, right? So that is something which is a bank processing float. But what if you receive the check today and you're not depositing 2 days later? So let's say today we are talking about 17th of Feb and we are depositing a check on 21st. So this check processing is also internal, guys. You are keeping your check with you. Why will you do that? So I think only float which probably will be there and beyond your control is what the bank requires for clearing of funds in case a particular payment is received by check, guys. Right? So I hope everyone is okay. So we just need to understand, okay, what are the types of floats, but we also need to know, okay, which are the floats which we can actually sort out amongst ourselves internally. Right? So collection management is something which is a solution for all of this. Of course, we can speed up the collections by reducing this time lag as long as possible, like as short as possible, and of course can be like issuing the invoice quickly or kind of going for online payments and all that. So there are some other aspects also, even if you're not going for online banking. Before that, there were some more solutions available, like a concentration banking, which is like more of a scenario where if you have customers in different cities, probably you might have multiple collection centers at different cities, and then all the checks deposited are deposited at those centers. So you are actually reducing the mail flow. No one is carrying your check to your office, to the head office, to the corporate office. Similarly, a logbox system. Now, logbox system is more or less an arrangement of the enterprise with the bank. So it's more of a scenario where you do a local post office box is kind of rented out, and you authorize the bank at each location to pick up the remittances in that boxes. And accordingly, you have to send the instruction to customers that, okay, your payment will be sent in so and so box number, and then the bank will kind of directly collect those checks. That means you are done away with the check processing float here. So you're not even talking about check processing float anymore then, right? And of course, so the idea is that, if you are talking about an online payment like an NEFT, RTGS and all, so anyways, you're even talking about reducing the bank processing float as well. So there are modern techniques where, you may or may not have any of these floats, right? Now, the other part was deferring the payments, right? So we know that, okay, probably whatever the time given by the vendor, I would like to avail that, right? If they're giving me 30 days, I might want to pay them on a 29th or a 30th day, right? If I make them payment on a 18th day versus 29th day, doesn't matter. I'm paying on time, right? The only thing is we will be discussing in towards the end of working capital management, when we'll be looking at the payables, what is the cost of foregoing the discount? What about if they are giving us discount for early payment? That is something we will be doing later on. Now, guys, a quick homework for you guys. So there is an illustration on your study material. Just check the page number if it is exactly on the same or nearby. So the illustration with respect to the Prachi Limited, which is kind of a good idea about how the float operates, right? So if there are delays, let's say a payment is taking, a clearing is happening on a Wednesday, payment is clearing on a Thursday. So this illustration talks about a good, a good understanding of how the float things happens and what is a cleared and an uncleared float. So please go through that illustration just to have a fair understanding of the concept. So other aspects of the cash management, as I said, that, what have been the developments recently. So you have electronic fund transfer, you have, a zero balance account. Now, what is a zero balance account? So it's more of a scenario, again, the coordination between the bank and, yes, Mansha, I agree with you. So Mansha, I think this is exactly what I've been saying, that she says that these floats have actually now reduced to a minimum because you have everything connected through a fintech, right? So your technology has been upgraded accordingly. So zero balance account, of course, you have an arrangement where you might have some temporary securities or let's say a demat account or something like that with the bank itself. And whenever you need the funds, those are disposed probably. Or if you have a surplus money, you can be investing there. Again, money market operations is more of a kind of having a separate depository where you could manage your investments. Then you're talking about electronic cash management system. It's more of a you have your entire net banking. You can check your reports. You can check your balances, accrued interest statements, and all that. And then you also have a virtual banking these days. I'm not sure whether you guys have actually visited any of the ATMs for many years. I think now almost like I've been seeing like for more than 4 or 5 years, there have been some, floats which I would say rather banks which have almost kind of a robotic system in terms of, let's say something like a passbook update. So like, for example, Bank of Baroda, most of their ATMs have automated, passbook update system. They have, services available in their ATM. So all these are the, virtual banking things which have been developed up. So, okay, so I get to just update from Charu and Sandeep. Yeah, so that was page number 10.52. That's okay. So, but glad that illustration number was okay. So that's okay, guys. So you guys can please refer to that illustration later on. Now, another aspect is management of marketable securities. Generally, when we are using the word marketable securities, we are looking at short term, guys. In the short term, marketable securities, of course, the idea is that you are investing the surplus funds. So basically, a very beautiful term we use here is we are just parking our funds here, right? We are just parking our funds in the short-term securities. And if required, you can liquidate them. Also, these securities carry negligible risk, guys. Negligible risk because we generally include marketable securities, maturity of 3 months or less. We include in cash and cash equivalents. And the idea is that you don't want to lose on the money. We are just temporarily investing in some risk-free investment. So generally, talking about government treasury bills. So there is no risk, probably a short-term deposit with the banks. Like I said that, the treasury department negotiates with the interest rate and all. And of course, the idea is you are focusing on safety. You are talking about maturity because you don't want to end up into blocking your funds for a longer term. And of course, you also ensure liquidity or marketability. That means, how quickly the funds can be arranged if required. So all these three principles are important in terms of the managing of the marketable securities. So let's have a quick check on example here. So what do we have here, guys? So Sri Bhakti Company, they are giving us some information with respect to this. On average, the debtors are collected after 45 days. Inventories have an average holding period of 75 days. Creditors having a payment period on an average of 30 days. Firm spends a total of 150 lakhs annually at a constant rate. It earns 12% on investments. The call of the question is, we need to calculate the cash cycle, cash turnover, minimum amounts of cash to be maintained to meet the payments, and savings by reducing the average monetary holding period by 30 days. Interesting question. Let's talk about this. So what would be the cash cycle in this case, guys? What could be the cash cycle? Anyone? Okay. Vasu has a question, commercial paper included in marketable securities. Vasu, I would definitely cross question on that one. So you're looking at a commercial paper. What do you understand from a maturity period perspective? Guys, what do you think? What is the general tenure in terms of maturity period? I think it's flexible, right? So I would say that if it's kind of meeting the parameter with respect to so when you're looking at a commercial paper, if it is meeting the criteria in terms of the short-term liquidity, definitely you could include that, right? The only problem I could say is with respect to the one of the criteria is because of the security attached to that. Because generally, the way traditionally the customer the commercial papers have been used, they have been unsecured. So that could be an issue over there. So as I said, the criteria has to be met of those three aspects which we mentioned on the last three slides. Otherwise, we'll not be able to include that. Okay, let me see the answers for this question then. Okay. So people are answering me about 90 days. Guys, are we getting 90 days here? So let's see. The data are collected as of 45 days. Inventory is available 75 on the creditor. So I think you're calculating as a 45 plus 75 minus 30. So it seems to be a 90 days is a good answer for us. Okay, that's okay, guys. So what about the second aspect? This is a cash cycle, but what is a cash turnover? What do you mean by cash turnover, guys? What do you mean by cash turnover? Can anyone tell me what do you mean by cash turnover? Let's see. Okay, I'm getting response from Sandeep. Sandeep says 4. So what we're looking at is a cash turnover, like just similarly what we talk about, how many cycles we have in a year. So if we have a cash cycle of a 90 days, we are looking at a cash turnover of a 360 upon 90, that is 4. So good job, guys. I think I can see 2 or 3 responses which are talking about a 90 days and a cash turnover of 4 here, guys. So that means we are looking at a 90 days and also a cash turnover of 4. Now the next question was minimum amounts to be maintained to meet the payments as they come due, right? So I think they have given us information with respect to a requirement of a 150 lakh annually. And we are talking about minimum amounts of cash to be maintained here. So that means during that, in terms of a minimum operating cash, we know that, okay, there is a cash turnover in terms of a 4 times. So probably at all the times you need a minimum operating cash, that is 150 divided by 4, because we are having a 4 cycles in a year. That means our minimum operating cash would be a 37.5 lakhs. That is 150 by 4, right? That's something we need to have. Now they have a question here then. Savings, that is by reducing the average inventory holding period by 30 days. Guys, what will be the answer then? Mansha, when you're looking, okay, I was just reading your comment. The management of marketable securities depend on the macro factors. I think that anyways, when we are talking about with respect to the risk-free aspect, right? So you don't want to go for any kind of a security where there is a more risk attached and risk is governed by the macro factor. So you are absolutely correct on that. So again, something which is impacting the entire bank or the interest rate, then of course those rates will come into the picture. Okay, so let's move on to the C part of this question, guys. What's happening to the C part? Now, savings by reducing the average inventory holding period by 30 days. So what was my average inventory holding period? 75. They want to change it to 30 days, guys. So that means 30 days or by 30 days? I think by 30 days. So we're talking about 75 minus 30. So we are talking about actually of 45 days here, 75 minus 30. So we're talking about a 45 days. So that means now my cycle would be, a new cycle would be 45 plus 45 minus 30. So that means we are looking at a 60-day cycle. And hence we are looking at 6 times that cycle will be churning throughout the year. So the sooner I am rotating my cash, so I'm having more number of cycles here. And if that is the case, that means my requirement in terms of the expenditure would be 150. But I am just need to understand that, okay, since we are given here that, okay, there is an annual expenditure, there is a very logical assumption because they have given us this annual at a constant rate. Right? So we are assuming it accruing evenly throughout the year. So in that case, the new requirement for the expenditure would be 25 lakhs. And hence we are talking about a reduction of the cash requirement by 12.5 lakhs. I hope you understand the part number C of this question. This is very interesting because what we are looking at, okay, the 37.5 is reduced here to a 25 lakhs here. And hence we are saving on 12.5 lakhs, and this surplus would actually be invested for earning a 12% investments. So 12 lakh 50,000, that is 12%, which will be a savings of 1 lakh 50,000 here. Charu saying what did not understand what C point is talking about. Charu, I think this is exactly what I was just explaining, that when we are saving, we are calculating the saving by reducing the average inventory holding. We need to understand what changes. What changes? So first, I made the holding time from 75 minus 30 to 45. So that means then we have to do the recalculation. What is my cash cycle now? Is 60 days. What is the number of cash cycles or the cash turnover? That is 6. And hence, because 150 lakhs annual expenditure doesn't change, and that is throughout the year. So that means amongst those cycles, we are talking about keeping a minimum cash of 150 divided by 6, 25 lakhs. So earlier we were needing 37.5. Now we are needing 25. This is the point which we are talking about. So that means a reduced requirement of holding cash by 12.5 lakhs that could be invested to earn a 12% on the investment. If we kind of invest that temporarily, we are looking at a 12% return. That means I am getting in return is 1,50,000 here. Charu, I hope that is clear. Okay, guys, time for some brain teasers here. Let's quickly do some brain teasing exercise. Okay, so let's see what is the answer for question number 1 and question number 2 here. Should be easy one, I guess. So please also mention the question number when you are answering, please. Question number 1 or question number 2. Okay, let me see what are the responses. Everyone is like point 1 is we are looking at okay, logbox. So I'm getting most of the answers as question number 1 is B, I guess. What about question number 2, guys? Okay, I'm getting mixed responses for question number 2, by the way. Some people are saying me A, some people are telling me C as well, guys. Make sure that you understand the call of the question was gross. Gross working capital here. Okay, let me see more responses. So I think, okay, I got an answer as B also. Okay, that is for question number 1, my bad, that's okay. So 1 is question number B and 2 is question number A if I kind of consider the majority here. But there are some students who are also telling me question number 2 ka answer is C. Guys, what was the difference between gross working capital and net working capital? We discussed that day. I think that the current assets probably, and the net working capital would be just a working capital or a current assets minus current liabilities. So I think you guys are spot on as far as question number 1 is concerned. I think more or less everyone said answer B, except for I think a couple of students who were confused between a concentration banking and a lockbox. Guys, we're talking about designated post office collection centers. That's a lockbox. And concentration banking is more of having some decentralized banking system. And you have then you have a concentration banking in terms of a collection center, not the post office box. So the answer to question number 1 is B. And question number 2, I think some of you mentioned C, but guys, C is not gross working capital, that's a net working capital. If they're asking you a working capital or a net working capital, then it is a current assets minus current liabilities, guys. So please make sure that we are being a little bit careful over there. Okay, guys. Now let's move on, and so there is a little bit more with respect to aspect of a couple of models which you should be just familiar about with respect to a cash management. Now, these are interesting models here. So the idea is that we all know that there are two extremes we want to be aware of, right? We don't want to have a surplus of cash, and we don't want to end up into a deficiency of cash, or we are not able to meet the payments as and when they are due. So there are a couple of models which has been historically helpful. Now these days, of course, we have much more modern techniques as well. So one is the Williams-Bowles model that is similar to the inventory management thing, economic order quantity. I guess you all have learned that model at relevant units. So this is a particular case where you need to find an optimum cash level, as we do for an EOQ. This is more of an EOQ model itself, where my carrying cost of the cash and what we used to do in inventory, guys, carrying cost and ordering cost, right? Now the carrying cost in terms of cash is what? If I'm keeping the cash, that means I'm not investing it somewhere else. That means there is an opportunity cost attached to that. So carrying cost is nothing but opportunity cost. And then instead of ordering cost, we are talking about transaction cost. In inventory, we used to talk about ordering cost, like every time we are making some order, we are incurring some cost. Similarly, in cash, every time we are talking about some transaction, some investment, we might end up incurring some kind of a commission or a brokerage. That's a transaction cost, right? So we need to find out an optimum level where the opportunity cost and these transaction costs are minimum. So you have a standardized formula based on the optimum cash balance, which will be provided. That is based on my periodical cash disbursement. That depends on any fixed cost or any charges per transaction, and also the opportunity cost, that is in terms of interest. So this is a model which is based on the EOQ model. Now another one which talks about is a Miller-Orr cash management model. Now this is more with respect to the fact that, guys, we need to understand that, yes, okay, what are the different levels in terms of the surplus and the deficiency, right? Now this is a very interesting one. What we are doing here is we are defining a range here, So what is happening is we identified 3 control limits in this particular model. So the control limits which are set for this model is, one is an upper, one is a return point, that is upper is like a higher, like a H point, return point is a Z, and a lower limit is a 0 or a lower number than Z itself. So let's say that a lower limit could be a 0 or any number lower than that, right? So what is happening here is that when we are looking at a situation that if my balance is more than the Z, guys, so what we are looking at, when the balance reaches H, that is an upper point, that means we're looking at this point here. So you can invest a amount H minus Z in the marketable securities. So that is why the Z level is a return point. So if you invest, you come up that at this point, guys. Making sense? So we invest H minus Z. Everyone okay with this, guys? And what happens is, if you are touching the lower limit, then probably you again have to sell the investments here, so that this time you again go to this level. So if you are kind of having a situation where you have an upper investment or a surplus funds, what you would do is, instead of we are talking about making an investment, that means my cash balance comes back to a Z level here. So we are investing the Z. Any balance which is, once it touches the H level, that means also an important aspect is, let's say my balance is somewhere here. Let me say somewhere in this range. Will I be investing any surplus, guys, as per this model? Yes or no? Or for that matter, if my balance is somewhere here, will I be selling any investment, guys? That is a question. So the range I have marked in red, will I be selling any securities or depositing any investments over there? I think the answer would be no, right? Because these upper limits and the lower limits are actually, occurring as acting as a trigger points. So we are looking that as a trigger points, because the main idea is that if I'm looking at the return point Z, we are taking that as a relatively a comfort zone. A little bit of a variation around Z is okay. But when we are looking at that extreme, when we from the Z, if we reach H, it will invest. And if we by any chance touch a lower level, it will liquidate, guys. So that means a little bit of a variation will not necessitate the action. These are the trigger points, H, point H and point 0. Right? So I hope everyone is clear, guys. Okay. So guys, now moving on from cash, I want to just quickly give you a little bit of an idea about the management of receivables. In the paucity of time, we'll not be discussing too much today. I just want to do a kickstart, and we'll have to wrap it up on Saturday, of course. So in terms of management of receivables, guys, if you remember our discussion on profitability and liquidity, we are thinking of as a lenient credit policy, risk of bad debts, and low receivables is strict credit policy and low sales volume. I think something like due diligence, or even we talk about customer credit limit adjustments could be useful here, right? Let's say they have been an older customer. If you can do this by managing this, could be good. If you can do analysis of respective customers, especially large customers, if they have been paying good, we might adjust, we might give additional credit limit to them. But let's say if you're talking about someone which is just a kind of a window shopper, you may not want to do any credit limit to them, right? So what are the various aspects of the receivables management? One is the credit policy, guys. So credit policy is, again, as we discussed, aggressive, moderate, or whatever, right? It's a trade-off between the profitability and of course there is a other side, that is we are looking at the cost of carrying those debtors as well. So either you go for additional sales with the cost attached, or you don't go for the additional sales, you may lose a sales volume. Now, I already told you that, sorry, Mansha's point is this optimum cash balance will help us to make the cash budget. Mansha, I would say that is just based on the projections, right? So if in a question they might give you optimum cash balance and any major iterations, minor iterations, then you may have to incorporate those as well. As I explained, in the William Orr model, that model can be still useful, like we did in a couple of examples, that we are given a 20,000 balance and anything over and above we used to liquidate. So you are absolutely correct. The only thing is, if there are minor iterations on the upper or lower side, unless given in the question, you might want to incorporate that as well. But otherwise, you're fine in that. Okay. So guys, also I told you about the credit limit, the credit terms. So like 2 by 10 net 30, guys. What does this mean? The credit team, this means that the credit term normally is 30 days. But if you want to if the customer pays you 10 days, you will be giving them 2% discount, right? So it comes under credit policy, probably the idea is what are the factors that could impact the credit policy? As I said, your firm's policy itself, the customer's reputation, and of course, what is your opportunity cost? Let's say if you want to get an early payment by offering some discount, you better be sure that interest avenues outside are higher than that discount. Because if you are giving a customer discount to get an early payment, you should be earning at least that much, or rather more than that interest outside, right? So that is a very important aspect in terms of deciding the credit policy. Then of course the customer background and the credit enhancement and all that. Now control of receivables is very good, guys. Now this is happening in every corporate right now. Very important, very critical. They do aging analysis. Let's say, how does this aging analysis happens, guys? Now, as an accounting policy, you all understand that the companies provide a provision for doubtful debts. So they can have an accounting policy, let's say 0 to 30 days, 30 to 60, 60 to 90, 90 to 180, and let's say more than 180. You might have a kind of a bad debts policy. So how much provision you want? Nil on this. Let's say a 2% on this, 5% on this, 10% on this. Let's say you have a 70% on this. Just an example, guys. So the companies can have a accounting policy on this case from an accounting perspective, but from a working capital management, they can follow up, especially these customers, regularly. They can have a quick monitoring, quick eye on these ones, follow up or write it off, right? So these are the basically aspects of receivable management. Now, what I would like you to do is, when we meet on Saturday, is I would like, apart from your regular practice, I would like you to kind of do a quick homework for me, and we'll continue from here on Saturday. That is the credit policy evaluation, guys. I'm just quickly giving you, just bear with me for 2 minutes. I'm just probably giving you a little bit of an idea about what does this mean. Okay. There are two ways to look at the credit policy evaluation. So what are we looking at is, let's say that existing policy is giving them a 30 days credit period. 30 days. And there are proposals that you want to, let's say an example here, this is 30 days present policy. There are proposals of a 45, 60 or a 75 days. Now, what we are to compare is that which is the best policy. I think you know the answer, right? Whichever policy gives us the best benefit should be selected. Am I correct? Now, how to evaluate these individual proposals? In the incremental approach, we will make the present policy as a basis, and the proposed policies, we will take only the differential amount, guys. So here we are talking about only differential amounts. So can I expect you guys kindly go through these two tables before we come on the Saturday's lecture as a homework? Just a quick check on these two so that we can attack some illustration to understand this, guys. I hope everyone with me on this. So this is a homework for you. I want you guys to just quickly go through these couple of slides. This is again in your notes. And then we can continue on Saturday from here on, and we can do some kind of a calculation, which credit policy is good, which credit policy is best. And of course, we will be also talking about something with respect to the factoring, guys. So these are the two very important aspects which I will be talking about on the Saturday, definitely. And we'll obviously follow it up with few practice questions as well. So that's what we will be doing in the final session. I'm sure some of you who joined late might be surprised that, hey, or rather surprised positively that yes, we are having one more session on Saturday for the working capital, guys. So I think we should be in a good position to complete with the credit policy, factoring, and few practice questions. That's the plan. But please do the homework, do some practice, and just do these reading of these couple of slides so that you guys are absolutely on the pace when we start on Saturday evening, guys. So as always, thanks a lot, guys, for joining in, and it was always an entertaining session and enjoyable with all of you guys. Amazing participation. So good job, carry on the good work, and study hard, guys. Best of luck. Have a good evening. Cheers, everyone. Bye bye.